Good morning, everyone. Welcome to today's webinar. Today we'll talk about our sector report on Singapore coal, which includes our initiation coverage on Golden Energy and Resources as well as Blackgold Natural Resources. And we'll also give results update on Geo Energy Resources and 800 Super. So our title is the fastest growing coal producers. Here are the investment thesis. So firstly, we will talk about the Indonesia coal market. Since all these three counters are Golden, Geo, and Blackgold, all operate their mining activities in Indonesia. So at the moment, Indonesia is the main source of imported coal to China, as it fulfills 40% of the China's imported coal demand. And also for domestic market, Indonesia will see a phenomenal growth of the domestic demand in the next couple of years. Since in 2015, the government initiated the 35 gigawatt program to increase the coverage of power supply to the whole nation. Secondly, we'll talk about China's coal market. Because China has been the major coal player in the world, and it dictates the global coal prices. So in recent years, China's government aims to reduce the coal production as well as consumption. As of December last year, the government announced the 13th five-year plan to further reduce the production and consumption target for next 5 years. So the last one, we'll talk about the Singapore-listed coal producers. Who are the three counters that they will have phenomenal growth in terms of production. So on average, they will ramp up the production by 60% this year. And in terms of valuation, these three counters are cheaper based on the PE and EV reserve multiples. So these are all the investment actions we initiated on GEAR, Golden Energy and Resources, with a buy call with a target price of 59 cents for next year. And for Blackgold Natural Resources, we also initiated with a trading buy and a target price of 16 cents for next year. So for Geo Energy, we maintain our buy call, but with a slightly lower target price of 44 cents. So why China is so important in the coal market? Because China is the price sector for coal. So you can see here, in terms of production and consumption volume, China accounts for 46% and 51% of the total raw volume. And especially during the period of 2007 to 2009, China started to turn from a coal net exporter to importer. So since then, the coal market started the bull run. Until 2011, China's government started to cool down the coal market. So as we mentioned before, Indonesia is the key source of coal imports to China. So on average, it accounts for more than 30% of the total imported coal to China. And for some months, the percentage can even hit more than 40%, even to 50%. So early on this year, in March, China started to ban imported coal from North Korea, which means that they need to find a substitute from the rest of other foreign countries to supplement this coal, this volume of coal. So here is the chart showing that how the authority in China guided and regulated the coal market from 2000 until 2016. So you can see here in recent years, China has been cooling down the coal market by curbing the production capacity as well as destocking for coal, and especially for the latest, the 13th Five-Year Plan and supply side reform. It clearly clarified that it will curb the excess capacity more in the next 5 years. So these tables are the summary of the main guidelines for China's coal market. Here are the details for the 13th Five-Year Plan for coal industry. So the gist of this plan is to slowly shift the reliance on coal to cleaner energy. But we think that the process will be quite slow because in the near term, China's energy consumption structure is still heavily relying on coal itself. So the next is Indonesia's coal market overview. So here I would like you to remember the two 80s. Means that 80% of the domestic production caters to export demand, and 80% of the domestic supply cater to the power sector. So as we mentioned earlier, the Indonesian government, they initiated the 35 gigawatt program. So in the next decade, we think that the domestic coal consumption will be expected to lean on the power sector. So here is the 35 gigawatt program. So as of 2015, the coal demand was reported at 71 million tons. So once they ramp up the installed capacity, based on the plan, this program, the domestic demand is expected to reach close to 100 million tons by 2019 and 111 million tons by 2020. And also PLN is the largest state-owned power producers in Indonesia. So every year they will announce the electricity supply business plan. So in the medium term from 2017 to 2026, within the next 10 years, it is expected that around 32 gigawatt of the thermal power will be added. So correspondingly, the coal demand will grow from 85 million tons this year to 155 million tons by 2026. So here is the peer comparison table that compare the three counters listed in SGX with those listed in IDX. So you can see that based on the EV reserve multiple, you can see that all these three counters EV reserves ratio is much lower than the peers in Indonesia. Also, in terms of production growth, you can see that the ramp-up amount is much higher than the peers in Indonesia. So we believe that the valuations for these three countries are undervalued compared to the peers in Indonesia. So this is the coal price outlook. As we say that before, China is the coal price sector, so we must focus on China's policy, how they dictate the coal price moving forward. So in third quarter last year, the State Council as well as the NDRC announced the initiatives that to encourage the coal producers and power producers to sign the mid to long-term coal sales and purchase agreement based on a price level of RMB 535 per ton, which is around 80 US dollars per ton. And early on this year, the NDRC also announced the thermal coal price alert mechanism, which classified the coal price level into three categories: the green zone, blue zone, and red zone. So when the coal price fluctuated or fall into the red zone, the authority will come out some regulations and take actions to stabilize the coal price, try to push the coal price fall back to the green zone and blue zone. So moving forward, we estimate that the average coal price, take 4,002 GAT as a proxy, will be around $37 per ton in FY17 and $38 per ton in FY18. So here are the coal trackers that we will monitor. So the first is the coal import volume from Indonesia to China, and also the local coal price reference. And also we will check the monthly thermal and hydropower generation in China. As of now, these are the two major sources of power generation in PRC. And also we will monitor the monthly coal production domestically in PRC. And the last one is the coal-fired plant checker for the in Asia. So you can see that in East Asia, the proposed coal plants that will be established moving forward will outnumber those in South Asia and Southeast Asia, because China will continue to expand the coverage of urbanization. That will increase the establishment of the coal-fired plants. However, we can see that in terms of the growth of these power plants, Southeast Asia will be the fastest growing region. So next is our initiation coverage on golden energy and resources. Our title is An Upcoming Giant. So these are the investment merits. It's quite easy and to understand. So this year they will ramp up their production volumes from last year's 9.5 million tons to 14 million tons this year. So as of the first half of this year, it already completed 43% of the target. And also for Golden, it enjoys low cash costs because the BIB mine's average life of mine strip ratio is estimated to be 4.1. So you can compare the its mining cost, mainly the cash cost, to the industry average. You can see here the gear's cash cost was around $20 per ton, but the industry's average is around $40 to $50 per ton. And also, gear enjoys abundant reserve for long-term development. So, upon the completion of the acquisition of BSL, which gear proposed in May this year, the total reserves will reach close to 1 billion tons. So the last point is product mix, is sales mix. Basically, gear focus its sales more on the domestic market. So you can see more than 50% of its sales will be supplied to Indonesia, then followed by China and India. So here is the reserve and production target table. So according to the company, they gives the guidance. They gives the guidance of production volume until to 2021. So you can see all the way to 2021 is production will grow from the current year's 14 million tons to 34 million tons in 2021. So here's the chart shows the ASP versus the cash cost. You can see that they can maintain the cash cost at a low level while the ASP increase more than while the growth of the ASP was more than the growth of cash cost. So that means they actually gain more margins from every ton of coal they sold. So in terms of the revenue breakdown, as we mentioned before, it focused more on the domestic market. So we believe that this sales structure can benefit the gear, that it will lower the geopolitical risk as well as the policy risk. So here are the key assumptions and variations. So based on the production volume that they guided, we think that for this year and next year, the coal sales will reach around 14 million tons and 17 million tons. And we think that the ASP will be around $40 per ton. So we derive our EPS for FY18 to be 4.34 US cents, and based on the peers average PER ratio of 10 times and the FX of 1.36 times, we derived the target price of 59 cents for FY18. So next is the Blackgold Natural Resources.
Yeah, thanks, Guangzhou. This is Paul here. Just on Blackgold Natural Resources, we initiated with a trading buy. Just a bit of background. Blackgold Natural Resources owns 3 coal concessions in Sumatra, as per the map on your right. But most important, or the concession to focus on is the Samantaka Batubara concession, because that is the only producing mine, and that's the one with the huge reserve of 147 million metric tons. The other 2 are still at the exploratory stage. In terms of the share price drivers, the first will be a spike in the coal sales. Coal only started last year with a small, meager 30,000. This is expected to spike to 1.3 million metric tons in FY18. The company has already secured 4 customers for this 1.3 million metric tons. So it's just a matter of producing and meeting and supplying this metric ton production. And as you know, in this coal business, it is the coal miners that does most of the production, and most of it is outsourced. The second share price driver will be more new customers. So far, they've secured 4 large customers. We won't be surprised if they secure more, because Sumatra is facing some sort of energy shortage of it. Because power consumption is expected to grow 11% per annum, or double, or power consumption is expected to double in the next 6 years. These numbers comes from from PLN, the government authorities, or the government power producer. In terms of the third share price driver, this is the big news event for them, will be the award of the Riau 1 mine mouth project. Very important to note that mine mouth project is the best form of coal supply business, because once this Riau 1 mine is open, the mine is just next to this power plant, and so the mine will have a captive or exclusive supply to the Riau 1 power plant. Assuming if this happens, this could actually triple the sales to 4 million from the 1.3 million, because this Riau 1 requires at least 3.5 million tons of coal per annum. So this Riau 1, once it happens, there's basically 2 sources of income. The first income will be supplying of coal to the power plant. The second source will be if Blackgold takes a stake in the Riau 1 power plant itself. Obviously, there are risks. The first risk is there will be the funding risk mainly, because they need at least 60 million capex to support this Riau 1 to ramp up production by 3.5 million. They need to spend 60 million capex. These numbers are actually in their IQPR that was just released, which is a qualified person's report on the details of this of their coal concession. The other second source of funding will be 54 million for the 20% stake if they do decide to take a stake in the power plant itself. Our target is about 10 times PE, which is the industry average for coal miners. Thank you. I'll move on to Geo by Guangzhou.
Thanks, Paul. So for results updates on Geo Energy Resources, our title is Poor Weather in 2Q17. So we maintain our buy call with slightly lower target price of 44 cents, and the last done price was 26.5 cents. Now let's take a look at the results. So year on year, of course, it outperformed last year a lot. because of the ramp up of sales volume as well as the higher ASP. But Q on Q, due to the prolonged monsoon season as well as public holidays, there was some interruptions of mining activities in second Q. So the production volume dropped from 2.21 million tons in first Q to 1.45 million tons in second Q. So however, the management still expected a higher volume of coal sales in second half of this year because the weather conditions will be better. So the 10 million production is still on track. So for the MTM issues, they decided not to proceed the refinancing plan of issuance of another senior note. And in the second Q, there were quite a big chunk of capex, including the acquisition of TBR mine and the jetty expansion and the payout for dividend. So the cash in hand was reported at 20 million US dollars as of June. We expect that the management will actively seek extra funding to repay the MTM by January next year. So the next is 800 Super Holdings.
Morning, this is Richard speaking. Okay, so we maintain our buy for 800 Super. Target price slightly lower, now 153 was 157. We are forecasting dividend of 4 cents, and that will give you a 3.4% yield over the last close price on Friday. So the company announced their full year results, which financial year ends in June. You can see here revenue was flat, and PATMI was just slightly higher year on year by 2.3%. There was a 9.4% increase in operating profit due to lower operating expenses. However, there was a higher income tax expense year on year. If you compare them with their other listed competitor, they did better for the 12 months ended in June. So for Colex, the 12-month revenue was negative 0.8% year on year, and net profit after tax was lower by 17% year on year. So there was a positive surprise for Yandra Super for their final dividend, which was higher than expected. They have proposed a 3 cents final dividend. Why it's higher than expected is because they have these ongoing projects, and we thought that they would be conserving cash in order to fund those projects. This 3 cents final dividend is also higher than last year's final dividend of 2.5 cents. And in total for this FY is a 4 cents dividend. They paid a 1 cent dividend, interim dividend earlier this year. So the two ongoing projects is the waste to energy plant and the sludge treatment facility. So the waste to energy plant is expected to be completed by the end of 2017, while the sludge treatment facility in second quarter of 2018. So we say that there's a stable outlook for the company, but there's a near-term weakness in their PATMI for the following 2 years because of the higher depreciation when the two projects are completed, but they remain underutilized during the ramp-up period. So because it's a non-cash expense, cash flow still remains stable, and that's why we still project a 4 cents dividend. However, for this current FY18, we are expecting negative free cash flow due to the capex for the sludge treatment facility. Okay, so we come to the end of the webinar. We'll pause for questions.
There is a question asking about the definition of life of mine strip ratio. So life of mine means the whole schedule mining life for the whole coal. Let's say life of mine is 20 years. That means the strip ratio for the average strip ratio for the 20 years of mining will be we will let's say 4.1 for BIB mine. That means like every ton of coal they extract from the mine, they need to dig out 4.1 tons of overburns, which is on the top of the coal. So for life of mine strip ratio, the lower the better. That means they don't need to extract many tons of the overburn on top to dig out the coal underground. So actually our report is already available on the website. You can go to the circle here, the stockbnb.com/webinar/. Thank you. So there is a question asking about is it the target price effective within the next 12 months time frame? Our answer is yes, because we project our estimations for FY18. So and we base on the PER, the forward 12 months PER ratio to derive the target price. So our target price is for next 12 months. Yes. So if there is no other questions, we will end our webinar here. So thank you for your joining in. We'll see you next week.